Hey traders, welcome back to Trade Empire. In this video, we will explain that how to identify key liquidity levels on the chart and how to use them for your benefits. And we will also explain market structure concepts. And we will also explain that how we combine liquidity concepts with market structure concepts. So let's start our video after a short intro. What is liquidity? When large financial institutes and banks wants to buy a large amount, they will need sellers in the market. The existing facility to place these positions is called liquidity. Liquidity is essentially determined by the placement of stop losses. Where stop loss is formed, liquidity is found. Smart money relies on grabbing the stop losses to enter the market. This allows them to establish their positions effectively. There are many types of liquidity in the market, but the first type is equal highs and equal lows. As you can see in the picture, in equal lows, price will form equal lows where the low points are about the same level. Similarly, the price will form equal highs where the highs are about the same level. But here's a question: what does it represent in terms of price action? The double or triple equal lows that are created on the chart are great areas to look for trading opportunities. For many beginner retail traders, they believe that price will once again reject from this area and give them a profitable trade. So they just open their long positions at these levels and set their stop losses below these equal lows. As we told earlier, smart money always aims to grab the stop losses. That's why you should enter the market after the liquidity has been grabbed. And if a demand zone or any order block area exists below these equal lows, there's a high chance for the price to break below these equal lows. Grab the stop losses and continue moving upward. Essentially, this is our trading pattern in the smart money concepts. We wait for the price to grab the stop losses of retail traders, and then we enter the market using demand areas or order blocks. Same concepts applies for the bearish scenario. When price taps at equal highs area, retail trader will go short there, as they expect a rejection towards the downside. They set their stop losses above these equal highs, as there's a lot of liquidity gathered above these highs. And if at that moment, smart money wants to sell, the conditions are ready to push the price above these equal highs to grab the liquidity, and then push the price to the downside as the original bearish direction. By learning smart money concepts, we will react at these levels as a smart money trader. We enter the market after the stop losses has been triggered and liquidity has been grabbed. Now let's move to a real chart example to learn practically. Here on the 4-hour euro-dollar chart, we have a clear uptrend, and the latest impulsive move has created this area as equal lows. And a common retail trader will expect that this area will act as a support when price taps on it. And many of them will set buy orders at this level. So below these equal lows contains lots of liquidity. But if we look a little bit closer, we can see this fair value gap and this valid order block or demand zone. And because these are just below these equal lows, there's a high chance for the price to tap into it and then start moving upward as its original direction. So, we will wait for the price to break below the equal lows, grab the liquidity, and then we can go long by looking at candles behavior. Let's see a bearish example. Here we can see that market is in a clear downtrend and form these equal highs. And if we look here, we have this fair value gap and this order block or supply area. So we will wait for the price to sweep the liquidity above these highs. But sometimes price only tap into the fair value gap and ignore the order block. So when price taps into the fair value gap, we will look at candles behavior, or we will look for any candlestick pattern. After that we will open our short position. Here when price taps into the fair value gap, we can see this rejection from the top. And after that we have this strong bearish candle, giving us a signal that price will move downward and continue its original trend. But you might say, is not breaking above this lower high considered a change of character? The answer is yes, it will be a change of character in simple scenarios. But in this particular situation, this change of character will be invalid, as many important market structures become meaningless with liquidity concepts. That's why liquidity and market structure are inseparable concepts in smart money trading. Now let's move to the next part of the video, combining liquidity concepts with market structure. When we say market structure, we refer to swing highs and swing lows, and price movements. Now let me show you some basic concepts about market structure in smart money trading strategy. We all know that in a continuous uptrend, the market continuously makes higher highs and higher lows. And every time price breaks a higher high to upside, it creates a break of structure. And it signals us that the price wants to continue in the same bullish direction. On the other side, if a candle break and close below the higher low, we call it a change of character, indicating a possible trend change. Here's an important point. In an uptrend, the lowest point between two consecutive highs is called swing low. Look here, we have two consecutive highs, so the lowest point between these two highs will be our valid swing low. Until the price is above this swing low, we are in an uptrend. And we will only look for buying opportunities, and for a valid change of character, we must see a candle to break and close below this swing low. And here we have another break of structure, and two consecutive highs. So the lowest point of these two highs will be our swing low. And another two consecutive highs, and this is the swing low. And remember, the same concept applies for the bearish scenario. Here comes a question: when can we say that a change of character will reverse the trend? Imagine we are in an uptrend, in a higher time frame, like in this example, and price is continuously creating break of structures to the upside, and making no higher highs and higher lows, and respecting the higher lows without breaking them. But if we zoom into the lower time frame, like 1 hour, we can notice that this 4-hour impulse wave consists of many impulse and corrective moves, and the higher lows are also getting respected there. But on the other hand, the price will create fakeouts before pushing the price to the upside, and when beginner retail traders see these types of fake breakouts, they believe that the price will now start moving downward, so they open their short positions and get stopped out immediately. That's why you need to learn the market structure in depth, so you can save yourself from these fakeouts. Here's an important point: the best trade opportunities are where the higher and lower time frame trends are in the same direction. At the end, we have a smart money checklist to make your trading setup easy and simple. This checklist contains some of the most basic smart money concepts, like drawing the recent schematics, identifying valid fair value gaps, identifying liquidity zones like equal highs and equal lows, finding demand and supply zones, potential trade opportunities, and risk management. So guys, if this video has provided you some knowledge, please leave a like and subscribe the channel for more trading videos. Wish you good luck for your trading journey.